With commission-free trading apps like Robinhood becoming super popular, and other brokerage firms such as Charles Schwab and TDAmeritrade going commission-free, plus ads like these for day trading classes online, stock trading has never been so popular with the allure of making millions. Now it seems like everyone is trading stocks or has a hot new stock tip that they believe is going to be the next Tesla and will double your money overnight. But day trading becoming so popular is actually having an effect on the market, and around 80% of day traders actually lose money in the long term. In this video, we're going to look into the effects of increased day trading has on the overall market, and why day traders actually tend to lose money in the end. Before we begin, don't forget to like and subscribe to support the video. Retail traders have taken off in 2020. Many people usually not interested in investing in stocks took advantage of stocks dropping more than 40% from the coronavirus. People also used their stimulus checks and invested that money with the hopes of accumulating some more wealth. People earning between $35,000 and $75,000 traded stocks over 90% more the week before receiving their stimulus. Also, during this time, major brokerage firms saw record new accounts being opened. Fidelity, for example, saw a record 1.2 million accounts open in the first few months of the year. Many people new to investing signed up for Robinhood, the commission-free trading app. In March, the startup said it saw 3 times its average customer trading volume compared to 2019. Also, another contributing factor could be the stoppage of sports and the closure of casinos, forcing more people to bet on other things such as stocks to get their gambling fix. Many of these new traders are buying stocks of beaten-down companies such as airlines and resorts. With Hertz announcing their bankruptcy, many new traders thought it would be a good time to buy in because the price of the stock was so low and they recognized the name. However, many didn't understand that with the bankruptcy, common shareholders usually end up with nothing and the shares become worthless. You can see the price of Hertz stock actually rise a few days after the bankruptcy announcement. This just shows you how many people were jumping in and buying the stock. I talk more about what happened to Hertz in my Hertz bankruptcy video if you want to learn more. From this price increase, Hertz actually tried to issue more shares and raise capital. However, this was blocked by regulators, as it was seen as misleading the shareholders and unethical to issue more shares as you filed for bankruptcy. This example just shows you how new traders are actually disrupting the market and causing an increase in overall volatility in stocks. Many of these new traders have yet to see the dangers in day trading stocks though. Around 80% of day traders actually lose money within a year, and the median loss for a day trader is 36%. Also, around 75% of day traders end up calling it quits in less than 2 years. This makes sense since you are taking such a big loss. This is a big problem though, because it discourages people from actually investing in stocks, and overall, it's not about timing the market, but time in the market. Instead of day trading, they should really use that money and buy and hold an index fund, consisting of many different stocks. The overall stock market tends to return 8% a year, but you don't see this average return in just 1 year. It takes several years for the returns to average out to 8%. So if you are buying and selling on a daily basis, you are going to miss the biggest moves in the market because it is nearly impossible to actually time the market. Also, day traders tend to go all in on just one stock. If this stock goes up, this is great, but if this stock goes down, it is the only stock they own, and your losses become much bigger. If you spread your money out though, if one stock goes down, it's not a big deal because you own a lot of other stocks that might be going up and it'll all even out in the long term. Also, diversifying is a good idea to spread your money out into different sectors. If all your money is in airlines and airlines take a big hit like we recently saw, you're going to have massive losses. But if you're going into airline stocks plus the tech sector and other sectors, you won't be taking nearly as big of a loss. Also, a study analyzed over 26,000 stocks from 1926 through 2015 and showed that only 1,000 of these 26 stocks accounted for all the profits in stocks since 1926. And out of those 1,000, only 86 were responsible for half the profits. So if you were just to pick one stock, it would most likely be the one that would lose you money. This study is a little skewed though, because it was looking at all stocks, including penny stocks and companies that weren't very good. If you just look at the largest companies, 80% of those companies' stocks increased over the past 10 years. So this just shows you that you should buy a little of each large company, and you will end up making a profit. Day traders also tend to be overconfident in their own biases. If they are on a winning streak, they tend to play more aggressive, thinking they are the best trader instead of just getting lucky. This leads to them actually taking bigger losses when their luck inevitably runs out. Day trading is also a very emotional thing. When you see a stock go up, it is a great feeling and you want to hold on and get the most out of the stock. This can lead to you holding on too long, however, and that profit can turn into a loss pretty quickly. Then if you see a loss, you might hold on to the stock with the hope that it will go up, but this will further increase your losses as the stock continues to go down. Also, if you see a stock shooting up and you don't own it, you might feel like you are missing your opportunity, so you jump in and buy the stock. But the stock was already at its height, and you have no chance of actually making any profit because you bought at the top. Emotion is a bad thing when buying stocks. This is why it is better to buy an index fund, so you can set it and forget it, and leave all the emotion out of it. Better yet, you can actually set up automatic investments, so you really don't have to think about it at all. People who are also opening these new Robinhood accounts tend to have low investment amounts. This makes them seek out super high risk investments so they can try and double their money. Let's say you have $5,000 to invest. Even if you make 30% profit, which is an amazing return on stocks, you still only gain $1,500. But a person with $200,000 would have gained $60,000. This makes people with small investments more likely to try and get a big win, rather than take safer, smaller wins. However, this just turns into them taking a more likely loss at the end of the day. With the increase of people getting into stocks, it is always good to remember that the best way to invest and build wealth for a majority of people is just to buy a diversified index fund and set it and forget it. No matter how much or little money you have, this is one of the best and safest ways to make money investing. Day traders might seem like they are making tons of money, but they never come out ahead. They might have a streak of good luck, but eventually they lose money. And don't get fooled by their flashy ads, because if they were making so much money day trading, why would they charge money and spend their time teaching people how to day trade? And with that being said, thanks for watching, and like and subscribe to see more videos.